She wasn't happy at first, but she said something I do think about a lot. She said, "I'm not angry. I'm just really confused why no one told me. I don't understand why I wasn't explained any of this." And the answer isn't that nobody told you because they don't like you, but it's not their job to tell you. Okay, let me tell you something that happened after my very first episode. I got a DM from a woman who had been in business, she said, for 11 years. That's 11 years. 3 employees, consistent 6-figure income, and she was doing pretty much everything right. She said, and I want to quote her directly, "I have been paying a CPA for over a decade, and I learned more from your 10-minute video than in 11 years of tax prep fees." And that hit me, not because it was a nice compliment, but because it told me something important about a problem that is so much bigger than the video that I posted. There are 2 financial operating systems in America, one that most people are running on and one that most people don't even know exists. And today we're going deeper into that second one, 10 more, so get ready to buckle up. I'm Aubree Denekamp, and this is Spicy Takes and Tax Breaks. And if you're here from the very beginning, the first 10 jaw-dropping tax breaks episode, welcome back. We're going further today, though. And if you're new here, I'm your write-off queen. I run AV accounting, and my entire professional obsession is this: making sure smart, hardworking people do not hand more government money than they have to. The law requires a certain amount, so it's not fully unavoidable if you are making money, but the whole show is about how to do what you are legally required to do, which you'll be surprised how many things you can do to minimize that. And what I've realized is after years and years of reviewing returns, sitting across from some of the smartest business owners who are genuinely doing really well, is that the gap between what people pay and what they legally have to pay is almost never about a bad intention. It's about misinformation or just not knowing. It's about a system that wasn't designed to hand you a rule book and say, here's what you do. So 10 more things that are in the rule book. Let's get into it. Number 1, this is actually one of my personal favorites because it sounds fake until you actually look it up. It's called the Augusta Rule. So this is section 280A. It's in the IRS code book, and it actually allows you to rent your personal residence to your business for up to 14 days per year. So you get to collect that rental income personally, completely tax-free, and have the business deduct the payment as a legitimate business expense. So let that land for a minute. Your business gets to pay you rent. You receive it personally, 100% tax-free. Your business deducts it, legal, document, 100% IRS-approved. So why is it even called the Augusta Rule? So when the wealthy golf families near Augusta, Georgia, had been doing this for decades during the Masters Week. So they've been renting their homes to, let's say, corporate sponsors, collecting that income personally, and they have to pay 0 tax on it. So some smart tax attorneys came around and they looked into the code and said, wait, this actually applies to all business owners. So in practice, here's how it works. Say you own a home. Your business needs a meeting space for something. Let's call it a strategy session, a client event, team retreat. You rent your home to the business, and at a fair market rental rate, of course, documented, receipt of payment, the business deducts it, you pocket the money tax-free, 14 days done. So at $500 a day, that would be $7,000 tax-free. It's directly to you, tax-free. $1,000 a day would get you $14,000. And get this, it's a business deduction. So the business gets to deduct it 100%. You take 0 of it at a taxable income. You just pocket it. And the documentation does require some real documents. So you cannot just write yourself a check and call it rent or Augusta Rule in the memo. It needs a rental agreement, a fair market value, which you can take a look at on VRBO, Google, Airbnb, just take a look. So whatever substantiated by whatever comparable properties would be if you rented it, depending on your area. I know Scottsdale, Arizona can get very high rates, but record of actual business use. That could be, hey, was I there for a team event, a retreat, strategy session, training, whatever that is, photo shoot. But if it's done correctly, this is one of the most elegant strategies in the entire tax code. This is one, if you're not using, definitely start using. And number 2 is one that I utilize strongly, but it genuinely makes me a little bit frustrated because people look at me like I have two heads when I bring it up most of the time. It's so straightforward though, and it's constantly ignored. It's called the accountable plan. So if you have an S-corp, which if you're self-employed and you're earning over 80,000, you probably should have an S-corp at this point, but you're legally then required to have a payroll. You pay yourself a salary, you pay payroll taxes on that salary. But what most people don't know is that there is a parallel mechanism that allows your S-corp to reimburse you for legitimate business expenses that you've personally paid for, tax-free to you, and a business deduction for your corporation. So we're talking home office, your vehicle, business portions of your phone and internet, different subscriptions you have at home also, professional development, supplies you personally bought. Let's get creative here. But most business owners just absorb that cost and call it a home or personal expense. They pay them out of pocket, but if you remember to deduct them, you get a tax break on both ends too. So with an accountable plan, you submit an expense report basically saying what you have paid for. So your S-corp reimburses you. That reimbursement is not included in your taxable income personally, and the corporation deducts it. So you just move money from your business to yourself without any sort of payroll tax, and your salary can be chosen after that amount. So this is one of those strategies that sounds super complicated because it has a name like the accountable plan, but it's genuinely a 1 to 2 page document that you write, and it's a monthly habit or quarterly reimbursement you do. So it can save up to $3,000 to $30,000 a year, depending on your structure. It's definitely worth it. So if you have an S-corp but don't have an accountable plan, please, after this episode, ask your CPA or your accountant or your tax software, what the heck are we doing here and why not? Number 3, and this is one that I cover often, but I covered it on an episode, Paying Your Kids Strategically. I do want to hit it again. It's one of my favorites and it's so, so important. But if you own a business of any kind, any structure even, and you have children between the ages of toddlerish years, upward of 17 or up to 17, you need to have them on your payroll. So for legitimate work, so you need to create a real job, real description for them. And it's then taxed at their taxable rate, not yours, which for most kids doing that is zero. Like they will have zero taxes on it because the standard deduction covers the entire income that is upward of $29,000 at this point. And the 32% tax bracket that you are at, by paying your child that $14,600, you are saving more than $4,600 in payroll taxes and federal taxes. So that money could be going into their Roth or IRA for their first investment account. It could be being used for things that they are wanting to do in their daily life, activities, sports, anything like that. So it could also be going towards a college fund. These are things that you would already be paying to the IRS in taxes. So why aren't we looking more strategically, creating a job for your kid? And depending on that entity structure, if you're a sole proprietor or a spousal partnership, there's absolutely even no payroll taxes or need for a return for the child if that child is under 18 years old. But documentation does matter here. So there does have to be a job description, time records or timekeeping. Their pay rate has to be somewhat consistent with what you would pay someone else to do that same exact work if you were to hire someone different. But this is not some sort of gray area. The IRS has issued guidance on this and it works and it's 100% legal. Number 4 is the home office deduction. And before everyone gets, oh, I've heard this one before, stay with me for a minute because what I actually want to address is the reason most people don't take it. And a lot of the time that is because of fear, specifically fear of an audit here. There is a myth that goes around often, and it is an old wives' tale at this point, but I want to be direct about it. Taking the home office deduction does not trigger an audit. It is not some sort of red flag you're waving around, and the IRS sees it and does not put you on some sort of list to watch. This is loosely maybe true back in the 80s or 90s when the IRS was much less sophisticated, specifically with all the deductions that are out there now. But the IRS currently processes hundreds of millions of returns per year, and this is all through automated systems. The home office deduction on a Schedule C for someone who actually works from home is absolutely not unusual by any circumstances. It's more so expected by these systems. So the audit rate for a small business are under 1%, under 1%. I want you to hear that, literally under 1%. So you are leaving real money on the table that you legally are allowed to claim. So potentially that could be up to $2,000, $18,000, depending on what you have per year on your situation, home value, size of your office, all those things. But you're doing this based on a fear that is less than a 1% statistic, essentially, is what I see with at least most new clients. But the rules here are pretty simple. So you have to have a dedicated space, regular and exclusive use for this business. You cannot use your dining room table that you eat at for dinner also and call it home office. But if you use a dedicated bedroom, a converted basement, a separate building on your property, take the dang deduction. Number 5 is going to be self-employment insurance, health insurance. And this one is both incredibly valuable and also consistently missed. So if you're self-employed, let's call it sole proprietor, partnership, S-corp, and you own more than even 2% of that business, you pay your own health insurance. Those premiums are fully deductible as an adjustment to your income. They're not an itemized deduction. They are an above-the-line deduction, so it reduces your adjusted gross income before you calculate everything else into it. So this means it reduces your taxable income, potentially affects your QBI deduction, and you may keep more percentage of what you have on the phase-out territory. So a family health insurance premium in 2025, 2026 can easily be $12,000 to $30,000 per year. So at a 24% tax bracket, that would be deducting up to $18,000, which is more than $4,500 back in your pocket federally. There is a catch here, though. So the deduction cannot exceed your net profit for the business. So say you are at a loss here, you won't be able to deduct the full limit. But for most operating business owners, especially ones who've been in business a while, this one is one of the largest single deductions available for any sort of admin step that you can take without any sort of legal or changes you have to make in your structure or even costs included. So I do want to pause you here for a second because we're kind of rolling through fast, but we are 5 strategies in, and I want to make sure we're not just collecting tips. I want you guys to be using them. The bigger picture that I want everyone to be taking a look at as we go through is that every single strategy that we have covered today, the Augusta Rule, accountable plan, child payroll, home office, health insurance, all of those are in the tax code and written for you right now, available to you if you own a business. They are not loopholes, gray areas, not a scheme. They are IRS acknowledged strategies that the federal government intentionally wrote into the tax code to incentivize business ownership and investment. And here's the uncomfortable truth that the system was not designed to come out and explain itself to you, to teach you how to use it. No one, unfortunately, sends you some sort of letter when you start a business that says, hey, here are 47 things that the government didn't tell you, but will reward you for doing. So here's how to pay legally less, and here's the playbook. It just, unfortunately, doesn't happen that way. It's not an accident, but you 100% are entitled to the same things. So the 2 operating systems that are in American finance are not about an income level. You can earn $500,000 upward on a W-2 and be completely operating in that one W-2 system. That is a default system, the one where tax is taken way before the money ever hits your bank account. So the options there are a lot more limited on what you can do, but there still are options. Or let's say you earn $150,000 from a business, and let's say you're operating in those 2 systems. You own a business, the one where your structure is working, your strategy, your information is working completely with your business, and now you have a completely different financial reality. So that's what this show is about. It's about showing you what 2 systems exist and how to implement them yourself. It's showing you the door and how to walk through it. It's up to you if you choose to or not, though. So before we get into number 6, everyone thinks about retirement. It's one of the scariest things, especially as inflation goes up, but everyone knows the solo 401k. I genuinely do think people get a little bit emotional often when this is brought up because the disparity here is so stark. Most Americans know what the 401k is. You work for a company, they have a plan, you contribute. They a lot of times will contribute too. And the contribution limit, even in just 2025 alone, was $23,500 if you're under 50 years old. So you can also contribute $31,000 if you're over 50 with that catch up, but that's it. That is your ceiling as the employee. There's no more contribution you can make for your 401k. But as a self-employed person with a solo 401k, you can contribute both as the employer, the business, and the employee as the matcher. So employee contributions are, let's say, $23,500. Employer contributions can be up to 25% of your net self-employment income. That combined for 2025 could be $70,000, let's call it. That's huge. That is much, much different than your cap at $23,500. So something to definitely take a look at. So it's $70,000 per year. All of it is tax deductible, and that is $46,000 more than any other regular 401k through an employer would be able to provide every single year. So for the same exact tax code, same two people, two different structures, same income level. The only difference is being self-employed, and knowing this account exists and how to use it is what the difference is. And another piece people actually do miss here is that a max solo 401k doesn't just have to be saved for retirement. There's other ways to use it. It reduces your adjusted gross income right now, today, which affects your QBI deduction, which also could push you below what your phase-out thresholds are, which can compound into so many more savings that we'll get into later. But the retirement account is the strategy to begin with, but it's also saving for your future. Number 7 is going to be Section 179. This is everyone's favorite online specifically, but bonus depreciation after the One Big Beautiful Bill. In July of 2025, the One Big Beautiful Bill was signed into law. And signing that into law, among a lot of other changes that it came, was 2 things that every business owner should know if you don't already. But you need to understand it before the end of the tax year. That means 12/31 specifically of this upcoming year for 2026. First, it in 2025 raised the Section 179 deduction limit from $1 million to $2.5 million, which means exactly this. You can now immediately deduct up to $2.5 million in qualifying business equipment, vehicles, property in the year you place it into service. Year 1, full deduction. So that means even if you buy that vehicle at end of year, full deduction if you need it. Again, strategy should be in place because sometimes you don't. Second, it permanently restored 100% bonus depreciation for property placed in service after January 19th, 2025. This was on its way to being phased out. In 2025, before this law, bonus depreciation was only at 40%. It was going to be 0 by 2027. It was being phased out. So now it is 100% permanently. That is huge and something that most people don't even understand. So what this means in practice is that if you bought a business vehicle, equipment, technology, or made some sort of improvement to your business property in 2025 or 2026 or 2027 coming up, you may be able to deduct the entire cost in that 1 year, not over 5 years, not over 7 years, year 1 if you need the deduction. So let's say that is $150,000 of equipment, and at a 32% tax rate, that's $48,000 back in the form of reduced tax liability this year. That is a reason smart business owners make capital investments decisions, specifically usually in December of quarter 4. That is it. You are saving so much money, whether $1 leaves your pocket or not. So again, making sure you're taking those quarterly meetings is so, so important. Number 8 is going to be that family management company. This one is a little bit more advanced, but it's worth knowing it exists and absolutely possible for a lot of people. So the concept behind this is going to be you create a separate management company, often an LLC owned by a family trust or a spouse or family member of some sort, but it provides basically a management or admin service to your operating business. This operating business then pays the management company a management fee. You guys get to determine that based on what structural and income cash flow allows, but that fee is a deduction for your operating business, the one that's being taxed at the higher rate. And the management company receives the income, but because of how it is structured and because of the income splitting between the ownership design, the overall family tax liability is lower than all of the income that has flowed through even to that operating entity. And this is usually why wealthy families use this consistently. It's why businesses that appear to run by one person often have 5, 6, 7 entities in their structure. It's not at all about hiding money, so I do want to be clear about that. It's about income characterization. So it's about spreading economic wealth activity across the structure, which the tax code definitely does reward, similar to why people say Elon Musk, Jeff Bezos, Warren Buffett, all of them. But pays absolutely $0 in taxes. Similar strategy here. Is this right for everyone? No. But this does require legal and tax architecture, but it does create such a tax savings if you are ready for that structure. But if you are operating a business, let's say doing more than $500,000 in a year, obviously more too, and you've never heard of this conversation, you should be talking to a tax strategist, a wealth advisor, anything like that, because this absolutely probably could be for you. A preparer is not a strategist, it's not their job, but it definitely is worth a conversation to have even just with your CPA. I do kind of want to give an example here. So I'll tell you about a client of mine. She came to me about 2 years ago now. She was great, very smart woman. It was a design firm, good revenue, great margins, actually. She had a CPA that had been with them the entire 6 years. So from the time of origination of the business, she filed every single year. They'd never had a problem either. They actually thought they had a great CPA. We sat down, they hired us for what was called a strategy session, which is absolutely different. We weren't filing their tax return. We weren't doing a review, by the way. But we're not looking at what happened historically. We're looking at what their goals are, what the next 3 years should look like or could look like based on what they want. And within about 45 minutes, I'd say we identified 8 out of the 10 strategies that we've talked about today that she wasn't using at all, that were 100% meant for her or she should be utilizing. So the Augusta Rule, her business held quarterly strategy days, and she'd been renting the conference room at a hotel in a Regis. She owned a home with a perfect space for it. She definitely wanted to utilize the tax deduction. She'd just never heard of it. The next was the accountable plan. She had an S-corp, had never reimbursed herself for even a home office deduction, had a vehicle personally, but drove it everywhere for business. The list goes on, but her kids, I think at the time, were 15 and 17. She was working at home constantly, had never been paid for any of that back, but solo 401k, never heard of it. She had, but thought it was for if you owned a corporation with 1 million employees that you had to contribute to. She did, though, have a separate IRA contributing $12,000 a year. But with that solo 401k, she could have been contributing up to $65,000 per year with the tax benefit. So the combined difference between what she had been doing, what she could have been doing legally, and what the structure was set up to could have been a difference between $35,000 to probably upward of $50,000 per year just on those strategies alone. She wasn't happy at first, but she said something I do think about a lot. She said something along the lines of like, I'm not angry. I'm just really confused why no one told me. I really like who I've been working with. I've never been audited, but I don't understand why I wasn't explained any of this. And the answer isn't that nobody told you because they don't like you, but it's not their job to tell you. A tax preparer, a CPA, an accountant, a bookkeeper, like their job is to record what has happened already accurately and compliantly. That's it. The proactive strategy, the wealth building conversations, it's a different service that most people don't even know how to ask for or that's out there. So something to consider as you're going through and taking a look at who you are using and what your plans are. There are services out there to help you get ahead of that, regardless of whether you move accountants or not. So keep that in mind. These strategies are something you can invest in yourself. These are in the IRS codebook, whether they're easy to find, but definitely take a look at someone who's going to help you build into the plan you're looking for. So number 9, and this is for any of the investors in the room. This is the qualified small business stock. So this is section 1202 of the tax code. If you invest in or found a C corporation with less than $50 million in asset at the time, when you acquired the stock at least, and you hold that stock for more than 5 years, you may be able to exclude up to 100% of that capital gain from federal tax when you sell it. That's 100%. The one big beautiful bill actually just improved this. So the exclusion amount, I believe, was raised by $15 million or 10 times your basis, whichever is the greater. But the threshold was raised from $50 million to $75 million in assets. This is what is so important, and it does impact hugely for founders. It is what matters for the angel investors. It matters for anyone who is investing in early stage companies. If you're investing in a startup and it's not structured as a C corp, you may be forfeiting one of the largest I've seen tax exclusions in the entire code. That said, The requirements are very specific here. So it has to be an active business. Domestic, it can't be a service company in most cases, some, but most not. But if the structure does fit, holding for 5 years and eliminating 100% of the capital gains is absolutely extraordinary and kind of unheard of. Definitely look into it if that's you. Number 10 is going to be the Qualified Opportunity Zone. So this is a program that was created in 2017. This allows for investors with capital gains from, let's say, selling a business to real estate, stock, anything like that, to defer, potentially reduce even those gains by investing into a designated low income, let's say, community called operating or opportunity zone. So this is a basic mechanism. So let's say you sell something and generate a capital gain. Instead of paying taxes on that gain, you invest a gain amount into a qualified opportunity fund within, I think it is 180 days. So what your tax on that original gain is deferred. If you hold that qualified fund investment for 10 or more years, you pay absolutely zero in capital gains on any appreciation that happens within inside that fund. That means zero on 10 plus years growth. And on top of deferring that original gain, this is particularly powerful right now because so many of those QOZ investments in the 2017-2018 range are coming up on those 10-year windows. So investors who understood this early were looking for tax-free exits are about to be benefiting huge. So if you have any sort of significant capital event in the horizon, a business sale, let's say a property sale, a large stock position, this is a conversation to have way before the event happens. If you have this after you've already sold, you are too late, unfortunately. So, okay, we made it through 10 strategies, 10 episodes, 20 total. What do you guys think? I want to close with something that's not really actually about tax, I think, for this one. But most of what we talked about today is about how you save. It's not really that complicated. Some of it might require some professional setup or guidance, but most of it just requires knowing how to ask the question. It is making an intentional decision based on how you're running throughout the year. And I think the reason that most people don't know how these things work, it's not some sort of like intelligent gap or that they're not smart or not doing it correct. It's not about the income level they're at. It's not even access to good accountants or CPAs necessarily. It's identity. It's this version of yourself that is running within that initial system we talked about. And it thinks I just need to earn more, make more, continue to grow. If I earn more, I have more. That's kind of the mindset. But taxes kind of work the same way. It's just what you pay. So the more you make, the more you pay. The more you make, the higher income tax level you have. The higher that bracket continues to grow. So most of us were taught that version, taught how that works. Not because someone's holding us back, just because the second version wasn't really part of any sort of curriculum that we went through. It's in things like this, in this podcast, in resources you can find online. So if you took any sort of notes today, you're good. Make sure you're asking your professional if you need help getting further through that. But go back through and identify, hey, am I using all these? If you are, good, you have someone who is advocating for you. But if not, which of these do apply to you if you're not using them? What can you use? What can you implement now? So have that conversation with whoever's doing your taxes, whoever's handling your bookkeeping, whoever you're working with in a capacity of wealth building or even just goal planning. And if that conversation really goes nowhere, if they can't answer the questions we're asking here today, these are pretty easy, basic ones. So if they haven't been proactively incorporating those, that might be most important to what you do next. So keep that in mind. A couple of things though before we go, if this episode has helped you at all, if any of these 10 things was a moment of like, shit, I should have been doing this, or wait, why didn't I know that yet? Share it. Send it to one of your business partners, your spouse, your kids, the entrepreneur friend that you always hear is working hard on something or wondering why the numbers aren't adding up at the end of the day. This conversation is something that everyone should be talking about. All of us who are making money do owe taxes. All of us who are making money do have to go through this hurdle. Let's not pay more than we have to. So if you want to go deeper, if you want to actually look at what your specific situation looks like and figure out which of these do apply to you and how much you can take on each of them, we can do a strategy session, not a tax prep, strategy. The link is in the show notes to get scheduled for that. Follow me on Instagram at The Write Up Queen. I post there pretty regularly. DM me Queen, and I'll send you the 2026 strategy guide based on what your structure and ownership is. And if you haven't subscribed to the podcast yet, please do. We are building something here and we want people to get reach. We want people to hear it. It's completely free. And I want you to be a part of it too. I'm Aubree. This is Spicy Takes and Tax Breaks. We'll see you next time.